Greetings, JT here, tickermonkey.com. Saturday, April 12th, 2025. I would like to discuss with you a trading rule I have around gaps. Precisely 2 to 3 gaps in a row. And this works directionally both ways. Clearly, we're looking at it through the lens of the market right now. So this was to the downside. Now, I put out a post on X on April 4th about this, but did not go into detail about how to execute when it happens. So in this case, we did get 3 gap downs in a row. We're looking at the cues on the screen right here. And the psychology, let's start with the psychology. The psychology around these gaps in a row, if you're running to the upside, and anecdotally, let's bring in a story. So Thursday, I'm a season ticket holder for the Grizzlies here in Memphis, and so I go to the game. Of course, my fellow seatmates around me, they know what I do. They're looking at the markets too. So the question comes to me about how's your week been? And so I can't really hide it. I traded futures all week, had a fantastic week. Okay. So anyway, I start in with the lesson to them of, well, there's a rule I have about multiple gaps in a row. And when it gets to 3 gaps in a row, that's the big one. And so I demonstrated with my hand in the air to them so they could see the extreme of and I told them, I said, if you have something that is running up in price, it's already running up in price, and then you gap and close at the highs. And then the next day it gaps up and closes at the highs. You're on watch. The next day it gaps up and it gaps up on that third day. You're selling it. It's done. Okay. And so after I tell them this, I say, and the opposite of that is if something's running down in price and then you gap down and then you gap down again and then you gap down again, you and the guy in front of me goes, sell. I just started laughing and I said, and that's how I take your money every single time. Now, it's not as clear as day as, oh, it's on its third gap, you sell or buy. No, clearly you just don't do it. You need a little bit more detail, and it's simple. It's the opening range. If you're on an extreme and you're gapping down in this example, and we'll get to the example here. So here's the cues, okay? So gap down, gap down. Now, let's pause for a minute because what was happening here is you already had a bear flag established. Now, at first, I thought this bear flag was going to break here, and it didn't. It drifted sideways a little bit more and popped up, and it gave us another anchor point. So if you don't know how to do a measured move, you simply take the high to the low of the flag. So there's your measured move. You get that number. You subtract it from whatever the peak of the bear flag is, and it gives you a target. For the, let's see, for the cues, the measured move of this bear flag was 419.24, which it's satisfied basically in the after hours on this Friday, April 4th. Okay. So 1 gap, 2 gaps. We're waiting on Sunday. And of course, the futures gap down open. The stock market carried over the next day. All these stocks, they had to gap down. The Qs, you can see down here, opened at 408.66. Now, to do the opening range, I use a 3-minute. You can use a 5. You can go, I'd say, as high as 15 minutes. The more you wait, the longer you go, it's going to be more skewed for your opening range. So if you're using a 60-minute, your opening range pivots are going to be a lot wider if that thing recovered earlier and made a move. So let's dial into how to go about this. So We'll jump down here. I added an extra, I only use a 2-day, 3-minute, but I added a 5-day so we could get involved in this video here. And let's make it where we can see a little better. So get over here. Okay, so you can see the 3-minute opening range high on the Qs was 410. Okay. On the SPY, we'll get to in a minute, it was 489.30. But on the Qs here, 410. Now, I will combine some things. I measure ATR percent from the open. So on an extreme situation, if you're gapping up or gapping down, for me, if it's a gap down like this, I want to see the moment that it takes out the opening range high. If it takes out the opening range low, you're waiting unless it gets to an extreme. If it continues to go down and makes a full ATR move lower below the open, so minus 100% ATR, I'm going to start getting interested down there. Usually what happens is sometimes it takes 1 hour, 1.5 hours. If it's just a normal drifting type move, at some point, the 21 EMA on that time frame is going to come down to price, or price is going to come back up to it. And that's an edge I have with trading around that. That said, you didn't get much time here. So, what is it? 12 minutes. You got 15 minutes. Your low was made. You start to turn back up. So, by 20 minutes or so, you're already back to the opening range high. This is your clue right here that the sellers are exhausted. This is failure, to progress lower. That is something that we look for all the time on extremes, especially on something that's sold down. So if you're trading Qs, if you're trading NQ, you're looking at the core 7, okay? Amazon, Meta, Apple, Microsoft, Google, Nvidia, Tesla. You're looking at those, whatever time frame you use. I use a 13-minute. I'm watching those on a monitor to my left, and I'm watching them with nothing else on that chart but VWAP and a VWAP envelope, but VWAP. And I'm just looking at the price action. Are they bid? Are they in sync? Is there one that's out of sync? Sometimes if Apple and Microsoft are out of sync, they have a higher weighting. They can drag on things. When you get them all in sync together, it makes for a better move. What happened was all of them were showing failure to progress lower. They all got bids down here on this low. They all stayed bid on the way back up to $410. You make a note of this. Now, if you use the 5-minute this day, if you use the 15-minute, they all had the same opening range high. It gets different if you went to 30 minutes or 60. It's much higher, okay? But the reason I like this lower time frame is I'll show you in a second. So we shoot back up. Of course, this was the fake news moment, which turned out not to be so fake, right? But and we ended up drifting the rest of the day. Nice OEL here that framed up the lows for that day. Tuesday, we ended up coming back in. Now, where did we find support at the end of the day? What was the low? 409.79. Okay, that was that opening range high. Retest. A little retest, undercut, reclaim. Okay, and the rest of the week has played out this way. But that's just a very easy way of taking note of the opening range on an extreme gap down. And that was for the Qs. These little white dashed lines you see here are the midpoints from the gaps. The way you do this, when it's a gap up close like this, you take this close, add it to the low of the gap down day, divide by 2. There's your midpoint. Same thing here. This midpoint is right there. And then this gap closed. So we're just simply taking the midpoint of this day. Okay. And I think, what is that number? 422.77. And that comes into play later as well. But you've made your low down here for the moment. You've retested and held that opening range high from this extreme gap down day. And you're just having this failure to progress lower. Now, there were other details that it's hard to go back and look at the price action after the fact and study those candles unless you're in it. Sunday, I traded from 5 p.m. on the Globex and, of course, took some breaks along the way. But I wanted to be up for the European Open at 2 o'clock in the morning. A lot of people aren't going to do that. Okay. You can go back and study the charts later, but you're just not going to get that real time what happened there. And at 2 a.m. Monday morning, Europe opens up. Obviously, they're gapping down too. The German DAX was down 9%. Okay, well, what happened was they halted momentarily. Their circuit breakers halted for a moment. The futures for us, the NQ and the ES, made a low like off the open for them in the sense of it blipped down. We blipped down. And here's the function behind that. They're halted. They can't do anything. So if they think it's going lower, they may try to hit the US indices to get a short, more of a short on or whatever. The computers do computer things. People do people-y things too. Very emotional things. We didn't even retest our low that we had made when we opened up at the 5 p.m. Globex. So we made a higher low there. Failure to progress lower in the face of here's more liquidity coming into the market now as Europe opens up, and we didn't press lower. That was a big key tell. And then we had a nice bounce from there. And I mean, I will say also when our Globex futures opened up, I'm going to pop over to that just real quick. So NQ, when NQ opened up here, it actually was an open equals high on the gap down at 17,100. So that was a pivot as well. And it was just another price point to watch for down the road. You know, you take note of these things of, well, that's what it was when it happened. Now, at the end of the day, that's not an OEH, but we know by being there when this candle started, it was an open equals high that flushed down for almost a full ATR and then started to turn back up. So you just kind of have to have all these little details, in your arsenal. But let's take a look at SPY real quick. So SPY, same deal. And its opening range high, as we talked about. Let me flip to that chart again. Where is that? There it is. I mean, it's really simple stuff. It's an opening range, and it's an opening range, not just any other day. It's an opening range on an extreme day. So you're just make note of those levels. So here's the 3-minute opening range high. Like we said earlier, it's 489.30. And what did it do? Right, same deal on Tuesday. Came down. What was the low on Tuesday? 489.16. That's a minimal undercut. I mean, if all undercuts could be that tight, life would be great, you know? But this was not without its challenges for people emotionally. But coming into this week, if you're looking to short things on the extreme, you're just kind of on the wrong side of things as far as, yeah, all the emotions were there. The news was the worst. We had more news that came out during the week of, when China retaliated and raised up, theirs against us. We didn't push lower. We actually went up. So, it's kind of, at some point, you kind of get it all priced in. Now, SPY, same deal. The measured move, go back, do your measured move. subtract from here, and its measured move target was 512.86. So you're already undercutting this bear flag, measured move price target. So you're already at an extreme. You're in an extreme. Look at the fib extensions on both of these measurements. You're under those two. Those are pivot points too for me. All of these things. I like to stack them all together. If I'm minus 100% ATR from the open, I'm reclaiming the 3-minute 21 EMA. I'm starting to come back up. I'm getting through the opening range high. I'm getting through a prior midpoint from one of these extreme days. I'm getting through one of the Fibonacci levels. They all line up together. The more edges I can stack up, the more I'm going to not only take that trade, but be a little bit more aggressive with that trade too. So, and really in this market, when you've got 3-minute ATRs on the NQ, for example, the ATR in this whole bear move has been about 40 points on average, 40 to 45, and that's super high versus, 12 to 20 sometimes. We got to 280 points on some of these spikes, and then it takes several hours to come back down, but you're still at 150 point ATR, and this is on 3 minutes. When I look back over some of these trades I was doing, and these were like 100-point trades, and so even if you're just trading a single contract on the NQ, 100 points is $2,000. So and I went back and looked over some of these things. Some of these trades were 30 seconds, not even. Some of them were even less. Some of them, when you get a runner on, were longer. But just being able to just take scalps on some of this stuff was extreme. But I did take some Qs at 40. What is my cost over here on these things? 408.09. I'm carrying some of those. I did take profits Sunday in the glow bags, and I free rolled all those profits into some shares in the T triple Qs just to keep that profit free rolling. Now, I'm looking over here at those now, 33.97. Those are 42.71%. I think at one point during the week, they got up to 57%. And then when we pulled back a little bit, well, not a little bit, but when we pulled back down, they were 16%. So, but that was just profits from trading that I free rolled over there into that instead of just booking them and throwing them back to the cash balance. But anyway, getting back to this, you just kept getting news that was worse to some people, and we just kept pushing. Now, this is interesting because you get a few more things here. We'll bounce back to the Qs, but candle combinations are a huge thing for me as well. And you can see Wednesday, you had a failed downside wick setup. Now that happens when you open below this close here and you're in this wick. The the psychology behind that is that's a downside wick setup. It's going to push lower. This would be the pivot where it triggers. Where it fails is when it gets back through this closing price here. And that closing price was 416.06. So you can see here's a 415.57 open, and you start to push back through it. Then you start to take back the midpoint from Monday. There's things going on there. Don't get emotional. Just take note of key price levels, and it's not the lines you draw and all that. Let price determine what these levels are. You just do the math, put the lines up, and pay attention to the price action that comes around them. Now, this was failure to progress lower. Again, we held the opening range from the extreme gap down, third gap in a row. So there's a lot of things that are stacking up to where you're just trying to put luck in your favor, okay? You're definitely not shorting down here. If you're doing that intraday, it's short and cute, but mainly what we were looking for was dip buying. Can price get soaked up on any pullback? Now it was extreme on Tuesday because, like I said, this right here, Wednesday, failed downside wick setup. Well, you got excited here on the open on Tuesday and gapped up. Well, failed wick setup. But that failed wick setup flushed all the way down and held that opening range high with a very minimal undercut and then closed back up a little bit. And then, boom, we got that news that came out. Lucky if you're long. So, there's, but again, when you start to stack up all this kind of stuff, you're putting yourself in a position to get lucky. This isn't some be 100% long situation and all that, but even on this bar here, and I see, this was a 3-bar break to the upside, but I also see my little thing down here that's denoting that this was a 10% price move with volume 300% above average. That's a little thing that I look for as well. Now, I view this as the follow through day. I know many people don't, but I'm not really concerned about that. Now, this wasn't a distribution day in the sense this volume wasn't higher. This is just rare stuff here, okay? So it's not going to fit any template. If you try to go make it fit a template, it's not going to fit. There's art to trading, okay? But we're always operating off of price. We can be artistic with some of our interpretations of what the labeling of the price action is, but the price action, where I've entered, how I've sized, what my stop is, that's all that matters. So anyway, this pullback here to this midpoint area, that's where we got. We got down intraday, down on the lows. We had undercut minus 100% ATR from the open. We got down there right towards where the circuit breaker was going to be. We actually traded on the futures. We went minus 7 point, I think it was like, I think we got minus 7.2%. I'm sitting there waiting on the circuit breaker to trip for the 15-minute halt. It did not. And then we turned. I got a good trade in there too. And we got a really good pop there. And then back and forth again. And the ATR ranges are still high. It's really, really crazy ATRs to where when you're using leverage products, you don't have to have a ton of contracts on to make a good amount of money. So anyway, and you can kind of see how we ended the week. Friday, it was the same deal. Friday morning, we were watching the opening range and just this failure to push lower. And so the way we were doing it in Ticker Monkey, we were buying dips during the day. Some people started to establish positions in certain names. There are some names that did really well, as far as the context of the tape we're in, they did well. But folks looking at the Palantirs of the world, Hood, CrowdStrike, there's other names like Celsius and Okta, but hell, even Cart actually finished. Now I'm not a fan of this one, but after what happened for the week, you start to look at the weekly price action. So oops reversals are something that I learned from a friend of mine that had subscribed to Larry Williams. Larry Williams used this on commodities. We took it and applied it to stocks. I've taught it to tons of people over the years. You see other people have started to do write-ups on it, put it in videos, possibly in other things coming out. But the oops reversal is something big for me. This is that psychology again. And on extremes, it's even better. Okay. So we're looking at a weekly chart here. There were only a few names from my watch list that had extremes as far as an oops reversal that then went bullish engulfing. Cart was one of them. Not my favorite name of the bunch that did it, but Palantir is another one that did that. Hood is another one that did that. CrowdStrike, another one that did that. And Microsoft, another that did that. Now, there's plenty of others that did that too, that I'm not following. There's plenty of others that did an oops reversal that then retook 75% or more of the prior week's range. Go and look for those things. Now, the Qs did an oops reversal too, obviously. Now, what we're looking at here, there's a candle combination called a piercing pattern. If this were to appear in reverse at the top, where you have a big up day and then it gaps and then reverses down with a big red candle and closes midway, you just flip this around. That's called a dark cloud cover. You go hit the AI and search it. Dark cloud cover, piercing pattern. This is the opposite of that. Dark cloud cover's bearish. Piercing pattern has a bullish lean to it. Okay. Doesn't mean we're going to rally right back up to the top. There could be chopping. There could be things going on. Don't know. There's some news over the weekend. We'll have to see. We may gap up Sunday in the futures, may have to back and fill a little bit. But right now we're in this point of when you have 75 countries in the queue to come and try to make a deal and things are getting walked back. You've seen the extremes of how it could go. Bond market dislocating, currencies going nuts to the upside, people debating, whether America's the leader anymore and the dollar's dead and gold's up. And I got to tell you, you keep an eye on gold as well, because gold may end up being a short up here, because same deal. And we're looking at GLD here. What's this? 1, 2, 3 gaps in a row. And actually, let's take a look at it real quick and just see. It did not really break down. So you got it hovering here. We'll see how this resolves. I heard a great comment about gold being the VIX of the world. I thought that was a pretty decent comment about it. But you can kind of see how here's this gap up, which it did start as an open equals low gap up, made the opening range, and then you started to see some sellers come in, pushed back a little later, and then comes back down again. We'll have to see, but take note of what was the opening range low on that third gap up, 297.87. So just write that down, take note of it, and we'll have to see if gold has now exhausted itself to the upside on a third gap in a row. And you may find some other fear type products that have done that. This right here was the VIX spike on Monday. What did it do? It was an open equals high, 60.13. They came in with their palms out, both of them, and sold as much as they could. There were bounces back up, all that, but you can kind of see now. I bet if we took the, actually, let's just do it here because I haven't done this yet. So this was an extreme day. So we want to take that high, 60.13. And then what's the low that day? 38.58. Divided by 2. So we got a 49.35 rounded up to 36 midpoint right in here. Well, a little lower. Whatever, you get the point. So watch that midpoint on any rallies on the way back up, and I don't know. We'll see. VIX being that high is usually a good sign. You had some other things that played out with put calls and all that type of stuff that got to some extremes too. But my main thing, tying it all back in, is these gaps on extremes. And then you just start to look out, and we've got this piercing pattern. We actually got the piercing pattern. You want to close back halfway into this. And so, we needed you needed four. What do we need? We needed 451.12 for the piercing pattern. Here we got it on the cues, I believe. We missed it on the SPY, just technically. You needed 536.24 to be the midpoint here. So pretty close, not textbook, but on the cues, you got a textbook piercing pattern for this weekly candle combo and all the other things that we've talked about here. So where do we go from here? We'll see. But, in this environment, to me, it just kind of feels like we got so far on the extreme that, we're going to rally just a little bit here. It may be a very choppy rally, but, I feel like we got a very rare follow through day on Wednesday, a day 3 follow through day. Now, I did see that Sir Webby was talking about the spirit of the follow through day for him was on Friday. The ability of how it held, inside day, other factors, but yeah. So if we end up, taking out Wednesday's high, that's really what you want to look at on names. So when you go through your watch list, see who's had these oops reversals, these engulfing weeks, but then really go back and look and who is already above Wednesday's high. Those are your standout type of names. So that's it for now. I've rambled enough, but that's the psychology behind it and the attack plan on it. So let me, you're looking for the opening range, you're looking for the reversal of the direction that you've been moving in. So in this case, down, 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 third gap, opening range, you get through the opening range high, you're starting to look at it and through the lens of it failed to push lower, it's now pushing back up. And then you start to look for it to fill those gaps back up where it came from. If it can do that, that's great. You have to watch them though for resistance too. But if it can get back and fill them, even better. And what did you do here? You ended up filling all those gaps. Did SPY fill all? SPY's a little bit short of filling all of those gaps. The most horsepower is in tech. So, and again, like I said, there's some news over here that I saw when I got up that apparently you're walking back tariffs on iPhones, computers, chips, that sort of thing. So, I mean, it stands to reason that we're probably going to have a sharp move in the Qs next week. We'll see. Like I said, we'll probably gap up Sunday, may fade back down a little bit. We'll see. But again, when you got 75 countries in the queue and they're all coming to try to make deals, and there's some strategy going on here. Don't know, we can't make sense of it all the time of what that strategy is. But I just know after you've hit the labeling of bear market, and yes, the sharpest up days happen in bear markets. Keep all these things in mind, but that's not a reason to not execute if price and your edges line up and there's trades to be had. It's a little tougher if you're trying to position trade right now. I do know some folks that have positions on that are not at their weightings that they would want them to be at. But if you're just a pure trader and you're looking at stuff, intraday, there's plenty of opportunities to be had. I mean, the candle combos, the patterns, they're all the same. You can frame up your risk. Actually, if you're using intraday ATR sizing strategy, you don't even have to risk a lot. You could risk. There's some of these trades on a system that I use, risking 10 basis points, where the sizing on some of these things was 23%. Some of them were even more, but the ATRs got so extreme on this 3-minute charts that the sizing would be a little smaller. I think some of them, like on Tesla, throughout the week were like 6%, and I think one of them got as high as 9. But uh, it was mainly the index ones that had the higher sizing optionality that went on. But anyway, um, just look at the psychology that goes on and the price action that's there, because people were freaking out about the bonds and all that. The bond market was doing what it was doing, and the equities did not sell down to make a new low. So here we are. And this day here, where we were down near the circuit breaker, that was kind of a normal pullback. We were looking for 50% of the range. And so we had that undercut of 50% of the range. And what were the ranges that day, actually? 50% of the ranges on the Qs that day were 441.63 and 520.84. So we were using those intraday too. Let's go and look at that real quick before I kill this video. We'll use a minute, stretch this out. I'm rambling a little bit longer. This is why I need time constraints. If I don't have time constraints, I will talk, talk, talk. So when we got down here, I believe this was Wednesday, right? Yeah. Where's that midpoint? Oh, sorry. I'm looking at Wednesday. I need to be looking at Thursday. Thursday, here we go. So the midpoint of that big rip on Wednesday, when we came back to Thursday, 441.63 was that midpoint from that big rip. So, you start to sell off here, and this is a good example. We got the gap down and we can't get through the opening range high. So you just kind of chill for a minute. And the assumption is, to us at least, the assumption was in the chat, how we were working, was we may end up retracing 50% of that big move. Now, yeah, it was going to be an extreme percentage, but when you put it in context of you just had a 12% up day, can you pull back 7% and it be considered normal? Yeah, you can. So here we go here. This ends up undercutting that midpoint, which, the range was so high that ends up being a 50%, minus 50% ATR here. You push down a little lower, you get below 75% ATR. There's one of your midpoints from earlier on that's on your chart you're watching. And then you start to get this turn up here, and then there's your 21 EMA. Doesn't go right away. Higher low, you're failing to make a new low, and you just start to drift back up, recovery mode. The main thing down here was those circuit breakers were threatening to trip, and they did not. And then you start to push higher. Algorithms most likely are going to come and bid at that first. The way we were playing it in the chat was we were under the assumption that if that happened, then that would probably be the low of the day. I think Duck and myself came in at the exact same time down here. And, again, when you're paying attention to the levels and you have them marked up, you know what you're looking for. At this point of the day, the chatter around was how bad things were. You can get distracted in all that noise instead of just paying attention to what is price doing at that point in time. And that was a big deal that circuit breaker didn't trip. It just kind of told us that there's probably a bid coming back into the market. And again, if you're trading Qs or NQ, you're looking at the core 7 and seeing, are they going to synchronize a bid together, start to push back up? And that's what happened. We ended up tailing back up. And again, we get the inside day. We did end up pushing a little to the upside to make this not an inside day completed, but we start out like this very rare double inside day off of this huge rip that is really good to see this come back up to hit the 21 EMA too. So again, we'll see how it all plays out, but we are leaning to buying dips and trying to find the best names that are standing up. And really, coming into earnings season, I think we're probably going to get some gaps. So we usually get some gaps, but these may be a little bit different. You may not get a lot of blue sky gaps. There are probably going to be a lot of gaps that are inside of bases. And, we've got some information on all that stuff in our gap course. Head over to Benzinga and, look at the gap course that John and I did and arm yourself up because the gaps aren't going away. I know you saw a lot of failed gaps, but that was the context of the market. We slid into a bear market briefly here. It may last. Don't know. Don't know if we're just going to V back up or anything like that. I have no clue if we're going to chop, if we're going to go straight up. I have no clue. All I know is I'm going to be taking note of the levels that the market dishes up to us and try to put it in context with all my different intraday edges as far as that goes, and see if those line up with the longer time frames. I mean, just all of it, put it all together, see what happens. But you don't have to sit here and stress about what names and all that. If you want to wait patient, my partner Erman, TML trader on our model portfolio, he's waiting patiently, and I am not concerned about that at all, because if things truly do turn, there are going to be plenty of names that come up that will get sized appropriately over there. And if they're trending, he'll latch onto them for everything they're worth. So, you don't have to be trading intraday. You can sit and be patient. I do both. So at some point, there will be some swing names put on. I'm still holding IBIT just because of how I'm positioned with it. It's a fairly decent position. It's 26% in some accounts, but this thing was bought in such a manner that I got it on that gap up initially, January of 2024, and built that up to where when we got in the trouble, I guess it's right here, this week in August, this is where I tripled that position up. And so the cost basis on that position, where is it? 31.89. And I've held. So I've had drawdown on this position as far as profits. But I was showing a little something on this the other night about, I think this was the sequential 9. I've got that turned off in here, but a DeMark indicator, sequential 9 there, ended up topping out. Got a sequential 9 here. This is that same oops reversal on the week. It's done some things. So base on base and IBIT, it's the same thing over on the Bitcoin futures. It's base on base. And we'll see. Actually, before I started recording this, somebody posted something out about the White House considering using the country's gold reserves to purchase Bitcoin. So, I mean, it's going to be all this kind of stuff that's just continuing to flow out. So I do understand the frustration of the folks that don't trade intraday and they just want to, take big swing positions and core positions and have a nice trending bull market. Go back and study the markets from when Trump was president last time. You'll get an idea of how that went when tariffs started and all that. I had a big Alibaba position back then with leaps and was up I think, what did I end up booking on that? It was like 2,361%. And I had all these leaps and they were up huge. And I honestly thought I was going to end up, let me pull up Baba. I actually thought I was going to end up taking this position and holding it for years. Like I did have it for years, but let's go with a quarterly here. So where was it? Quarter. I think it was, yeah, it was pretty much the start of 2018. And that's where that trade got killed off. Of course, it did end up going up higher from there, but I ended up booking it as it was coming down. It was just too much when you're seeing something that's, up 3,000% start coming in and all that. And I was trying to take delivery on a lot of those options contracts. I mean, that was such a beautiful position. It was before 0 day options and all that stuff. So it was just a it was just a beautiful leap option trade on Baba that got killed because of the tariff stuff and all the other stuff too. But yeah, God, that was you were able to take it was basically like 5% equity risk for 120% position size when you tacked up all the notional value. So you really only had to take 5% of your capital to control this 120% position. That's what it would have been as you took delivery of all the option contracts. So it was really a yeah, I have not been able to replicate a trade like that with options because everybody's looking at the options market, as you know, has exploded over the years, and the premiums are not dislocated like that. There's just so many people playing options now that there's premium to everything. When we got involved in that trade, there was not a lot of premium, and so that's how you were able to buy an option for $1.80 and then see it rip to 60. And you know anyway, I guess now that's just the 0 day option trade, right, for most. But anyway, all right, I'm gonna stop rambling. 47 minutes. You see what happens when you let me go with no stopwatch. But hopefully you got something out of this. That's the way you go about these gaps. Piercing patterns on the weekly, oops reversals, open equals high, open equals low. Look for all of these things. You will certainly find these things around bottoms. Um, Open equals low starts to happen around bottoms. That's a great sign. 3 bar breaks to the upside start to happen. That's a great sign. Any of those that, is a combination with a wick setup, great sign. You start to get oops reversals or 3 bar breaks happening on a larger time frame like a weekly. That's a great sign. As I flip back to the weekly here on the cues, I mean, this is an oops reversal, so we'll see. You can kind of see how it started to get excited there, and it was an oops reversal back down. That's that bear flag triggering. So could end up being some back and forth, but I have no idea. Back and forth, V back up, build a base, chop around, whatever. Take it day by day. Day by day, level by level. That's what one of my mentors told me years and years ago. God, how long have I been doing it? 26 years. 20, I guess this will be 27. But a lot of lessons over the years. But the biggest one is just these gaps. And go back and look. I think it was the April 4th post on X, because the example I gave was, you can go back and look at the cues at June 9th, 2022, June 10th, and then that was also 2 gap downs into a weekend, and then on June 13th, another gap down. Then we reversed and bounced and had a little relief drift until Jackson Hole. which was like in August. And then that's when we ended up going back down, undercutting those lows. But those, that whole little area there, it was a level to watch for the undercut reclaim later on. But it was the same deal on that market finally bottomed out on October 13th of 2022. And that's where I've still got my cues from then, this whole way up. That 255 13, I think it was, that I paid that day. Um, but of course I've added and subtracted along the way. And so there's that. But you have to pay attention on these extremes too. And one more thing, go back and look at the names that did not make a lower low with the market. Now, Celsius is one of those names. Okay. Now it was already washed out. No, there's nobody left to sell this thing, clearly. Gapped up on the earnings. They made the acquisition of whatever that company, Alani, or I don't drink any of these things. So, I've never really had the full conviction on these types of names because I don't drink coffee, just water. But you can see this gap up, came back in, filled the gap, but here's our gap U-turn that we like so much. And you can kind of see when you start to look at the U-turn on these types of situations, obviously you don't like them to fill the gap at all, but context of what the market's doing, all that sort of thing. But here's an oops reversal. Here's a 3-bar break. Here's another 3-bar break. That's a wick setup. Here's an open equals low as you're coming to the, almost to the lip here. Your little HVC, you're closing above it there on this OEL day. And then here's this mini gap that did not get filled. And, you keep getting these little pressure to the upside type situations. 3-bar break, oops reversal, 21 EMA. So Celsius is one that's already in front of the market as far as moving up and out. And you just have to go and see who made their low before the market made the low, and then look at each name individually through the lens of day one and a follow through day, and see which stocks had their own individual type of follow through day before the market had the follow through day. So who was already blasting up and out before, the market this week? Most of them are in line with the market making the low, but you want to go find those names that are divergent and showing that early leadership, because those will be the ones that probably make the biggest move. Just tends to be the way it works out. But anyway, I will stop rambling, wrap it up. Everybody have a great one. Geez, this was 53 minutes. Apologies, but hopefully you got something out of it. So everybody have a great one. Catch you on the other side of the tape.